Welcome to the Explainer, Future CPAs. Look, if you're an accounting student staring down the Management Advisory Services part of the LECPA, you are in the exact right place. Today, we're bringing the energy because our ultimate goal is to crush Quiz 5. We're going to lock these concepts into your brain so securely that you'll still remember them 3 years from now when you finally sit for the actual board exam.
So let's dive right in by challenging you with the ultimate board exam trap. You already know how to find the basic break-even point, right? That's where revenues equal costs and profit is exactly zero. But in the real business world, and definitely in the Philippine LECPA, companies don't just want to break even, they want to make a specific profit. And what happens when the taxman steps in? Well, the most common reason students lose easy points on this exam is by totally ignoring the crucial difference between pre-tax and after-tax profits.
Section 1. The Target Profit Trap.
Listen, board examiners absolutely love testing to see if you actually know which profit figure you're looking at in a given problem. If you read a problem too fast, boom, you might end up calculating the wrong goal entirely. To dodge this trap, we have to strictly separate two terms. Target operating income, that's your profit before taxes. On the flip side, target net income is your profit after taxes. It's simply operating income minus income taxes. And here's the kicker. Target net income is what top management and the exam really cares about, because that's the actual cash the company gets to keep.
Section 2. Equation and Formula Methods.
Before we even touch the messy tax calculations, we need a rock-solid foundation on how to hit a target profit in the first place. We've got two main ways to solve for this. First up is the equation method. It's foundational, telling the whole story. Sales equals variable costs plus fixed costs plus profit. Then we have the formula method, where you take your target profit, add fixed expenses, and divide the whole thing by the contribution margin. Now, while they are mathematically identical, the formula method skips a whole bunch of algebraic steps. And as you know, saving time on the LECPA is basically a superpower. And hey, don't forget the core mechanic making both of these methods work. Whether the exam asks for your answer in units or in pesos, cost-volume-profit relationships rely entirely on the contribution margin, or CM. The CM is just your sales minus your variable costs. It's literally the engine of our calculation. It steps up first to cover your fixed costs, and then whatever is left over, that generates your profit.
Section 3. Factoring in income taxes.
All right, we've got our baseline. Now let's move to the complication that makes students panic in the exam room. Say you're reading a problem, and it asks how many units a company needs to sell to earn a target net income of a certain amount. Ask yourself this crucial question. Why do we immediately need to calculate the target operating income? Well, the answer is that our standard CVP formulas, the ones we just went over, only work with pre-tax operating income. They literally don't speak the language of taxes. So we have to work backward. So here is your magical anchor. Seriously, lock this into your brain for the next 3 years. Whenever you see the words net income or after-tax profit on a test, your brain must immediately divide that number by 1 minus the tax rate. This is the golden key to unlocking the whole problem. Let's actually walk through the logic of why this works. If a company's tax rate is 40%, that means they pay 40% of their operating income to the government, and they get to keep 60% as their net income, right? So the net income represents exactly 60% of the pre-tax total. By dividing the target net income by 0.60, which is just 1 minus 0.40, you reverse engineer the math to find that original pre-tax amount. Section 4. Target net income calculations. Okay, let's turn this into a foolproof, step-by-step hack for literally any target net income problem they throw at you. Think of this as top-down reverse engineering, where we convert the after-tax goal into the pre-tax variable our formulas actually understand. Step 1. Identify your target net income from the problem. Step 2. Divide it by 1 minus the tax rate to get your target operating income. Step 3. Plug that new, larger number straight back into your trusty CVP formula. Let's see this math in action using a classic textbook scenario. Let's say your target net income is $960 and the tax rate is 40%. You just take that $960 and divide it by 0.60. That gives you a target operating income of $1,600. It is really that simple. Once you've got that $1,600, your pre-tax operating income, guess what? The taxman's job is done. You don't need to worry about him anymore. You just drop that $1,600 right back into the standard formula method from earlier. Add your fixed cost to that target operating income and divide the whole thing by your contribution margin per unit. But wait, pay super close attention to what the question is asking for, because this is another trap.
If the question asks for the volume in actual units, like how many cell phones or pairs of shoes you need to sell, you divide by the unit CM. But if the question asks for the total revenue required, meaning the answer they want is in pesos or dollars, you divide by the CM ratio. The top half of the formula is exactly the same, but the denominator changes everything. All right, let's keep you on your toes. I'm going to throw you a curveball. This is one of the absolute most common conceptual tricks in the MAS exam, testing if you truly understand the relationship between profit and taxes. Trick question: does a change in the income tax rate affect the break-even point?
The answer is a massive, resounding no. The break-even point is completely unaffected by income taxes. Why? Well, because at the break-even point, your operating income is exactly zero, and zero profit means zero taxes. Any percentage of zero is still zero. So whether the tax rate is 10% or 90%, your break-even point never shifts. Remember that, and you've just guaranteed yourself a point on the board exam. Section 5. Study hacks and review. It's time to lock all of this into your long-term memory. Go ahead and take a mental screenshot of this, because this is your high-yield bullet review for Quiz 5. I want you to mentally anchor these 4 rules every single time you see a CVP problem. Number 1, read carefully and always check if the profit is pre-tax or after-tax. Number 2, convert net to operating instantly by taking net income divided by 1 minus the tax rate. Number 3, default to the formula method to save precious time. And number 4, taxes never affect the break-even point. So, you now have the exact tools to absolutely dominate single product target profit problems, even when they try to trip you up with taxes. But before you get too comfortable, I'll leave you with a provocative thought for your next study session. You can find the target profit for one product easily now, but how are you going to handle the math when a company sells 3 different products at once, all with different contribution margins and a constantly shifting sales mix? That is where cost-volume profit analysis gets really interesting. Keep studying hard, stay focused, and you are going to ace that exam.